Welcome back to Lion of Crypto, the channel where we talk about crypto the way institutions actually view it, not the way headlines try to sell it. I hope you're having a great day wherever you're watching from, and especially if you're tuning in during a busy or quiet week, I genuinely appreciate you spending your time here. What I want to talk about today is not just another routine XRP update. What we're seeing right now is something much bigger, something that most people are not mentally prepared for yet. 2025 has turned into one of the strangest years we've ever seen across financial markets. On the surface, everything looks strong. The S&P 500 is hovering near all-time highs. The Nasdaq continues to push higher. The Dow keeps printing new records. Even precious metals like gold and silver are hitting new highs. Normally, that combination signals confidence, stability, and long-term growth. But at the exact same time, the crypto market, especially Bitcoin and XRP, has been under pressure in a way that simply doesn't line up if you're only looking at the news. Bitcoin is still down significantly from its peak, and this has turned into one of the weakest fourth quarters we've seen in years. And here's the part that should really make you stop and think. There has been no major scandal, no exchange collapse, no FTX-style disaster shaking confidence. In fact, most of the headlines this year have been positive. ETFs moving forward, institutional interest increasing, regulatory clarity slowly improving. So the obvious question becomes unavoidable. Why is price action not responding? When price stays disconnected from fundamentals for this long, history tells us there are only two real explanations. Either the market is completely broken or price is being intentionally suppressed. And when you look at how much liquidity, power, and control large market makers and whales actually have, it becomes very difficult to ignore that second explanation. What we are witnessing in 2025 does not look like random weakness. It looks like deliberate pressure, and in many ways, more manipulation than we've seen in the last 7 years, including periods of real chaos. What makes this year stand out is that this pressure is happening while fundamentals are improving, not deteriorating. That's a major red flag. Historically, that type of environment has always preceded massive moves, and this is where XRP enters the conversation in a very different way compared to the rest of the crypto market. XRP is not being positioned like a typical retail speculation asset. It's being positioned closer and closer to institutional infrastructure, and assets that sit close to institutions simply do not move the same way meme coins or hype-driven tokens do. What appears to be forming is a potential decoupling event, a moment where XRP stops moving in sync with the broader crypto market. While other assets remain trapped in volatility and uncertainty, XRP begins to trade on a different set of rules altogether. Rules driven by liquidity needs, settlement demand, and solutions to systemic risk. This idea isn't new, but the timing is becoming clearer. We're approaching a period where global liquidity has to return, not because markets want it, but because the system needs it. Debt levels are rising, bond yields are climbing, and systemic stress is building across multiple regions. Japan is a perfect example. Their 10-year government bond yields have surged to levels they haven't seen in years. That's not normal for Japan, and it signals serious stress beneath the surface. When pressure like that appears, central banks and financial institutions are forced to respond. Liquidity always follows crisis, and when liquidity comes back, it doesn't flow evenly into everything. It flows first into assets that are already positioned close to the system, and that's where XRP's role becomes critical. At the same time, we're seeing massive players quietly positioning themselves, large institutions exploring crypto exposure, asset managers speaking openly about certain assets while remaining silent on others. Silence at that level is often more revealing than headlines. XRP has a long history of extended suppression followed by rapid repricing, not because retail suddenly gets excited, but because positioning is already done behind the scenes. OTC desks, private deals, and institutional accumulation happen long before price reflects it. Retail almost always finds out last. This is why so many people feel confused right now. They see positive news, but no movement. They feel like the market is broken. In reality, the market is doing exactly what it has always done before a major transition. it exhausts patience, shakes out, weak hands, and creates disbelief, because this is the phase where most people give up. And markets don't move because of one headline. They move because pressure builds quietly over time, and then everything releases at once, Right now, that pressure is building across global financial systems, and crypto is sitting right in the middle of it. One of the biggest misconceptions retail participants have is believing that price discovery happens openly on exchanges. In reality, the largest positions are built away from public order books. OTC desks, private negotiations, and dark pools exist for a reason. Institutions cannot accumulate meaningful size without moving price against themselves. So when price stays flat or suppressed while fundamentals improve, it often means accumulation is happening somewhere you can't see. This is especially relevant when we talk about XRP. XRP is not being accumulated for hype cycles or short-term speculation. It is being accumulated for utility and positioning. Institutions don't buy infrastructure assets at market tops. They buy them when sentiment is low, when retail interest fades, and when patience is exhausted. That is exactly the environment we are in right now. Frustration is high, engagement is low, and belief is thin. Historically, that combination has always created opportunity for those thinking several steps ahead. At the same time, global liquidity conditions are clearly reaching a breaking point. Japan's bond market isn't just a regional issue. Japan is one of the largest holders of global debt, and when their yields spike, the shockwaves don't stay contained. Rising yields mean rising costs of capital, and rising costs of capital eventually force intervention. History is very clear here. When systems become unstable, central banks respond with liquidity. They cut rates, inject capital, and attempt to stabilize markets. That liquidity doesn't just remain in equities. It flows into assets that can move value efficiently across borders, and that's where blockchain-based settlement becomes extremely attractive. This brings us back to XRP's design and positioning. XRP was built to move value quickly, efficiently, and at scale. Those characteristics don't matter much during periods of excess liquidity and speculation, but they matter enormously when stress rises and systems begin to strain. That's why Wall Street pays attention quietly, not loudly. When people inside traditional finance start discussing XRP as a settlement tool rather than a trade, that's a meaningful shift. Understanding always comes before adoption, and adoption always comes before capital flows. Another important layer here is political and monetary policy signaling. Discussions around potential leadership changes at major central banks are not random noise. Whoever controls monetary policy shapes liquidity conditions for years. Markets don't wait for official announcements. They price expectations early. This is why you often see positioning happen long before headlines confirm anything. Liquidity is the fuel that drives all markets. And when liquidity returns, it doesn't trickle in slowly. It floods. And when it floods, it looks for efficient pathways. This is where ETFs come back into the conversation. Many people underestimate the power of ETFs, not just for price exposure, but for legitimacy. ETFs act as bridges between traditional finance and digital assets. They allow large pools of capital to enter without changing behavior or infrastructure. And we already know that the coming years are expected to bring a wave of crypto ETFs far beyond just the first major assets. XRP fits naturally into that environment because it already has regulatory clarity relative to many others, established institutional relationships, and a use case that aligns with how large financial players think. That combination is rare in this space. Now, let's address manipulation again, because this is where emotions usually take over. Manipulation is not always illegal. Often it's simply capital using its size advantage. Whales and market makers don't care about narratives. They care about positioning. When you see repeated suppression near key support and resistance levels while accumulation indicators quietly improve, that's not accidental. The largest manipulation events are never obvious in real time. They only become obvious in hindsight. By the time the move happens, most people are already out. This is why patience is such an underappreciated advantage. Markets are designed to transfer wealth from the impatient to the patient. Another critical factor is retail exhaustion. Many people have already stepped away from crypto entirely. Others are disengaged. They stopped watching charts, stopped believing, and stopped paying attention. That is exactly when institutional players feel most comfortable stepping in. When no one is watching closely, positions can be built efficiently without resistance. XRP has always moved differently from the rest of the market. It lags, it frustrates, and then it moves violently. This pattern has repeated multiple times over the years. The reason is simple. XRP's demand doesn't come from hype alone. It comes from structural needs that appear suddenly when conditions align. When that decoupling finally begins, it will feel unfair to many people. It will look like it came out of nowhere. But in reality, the groundwork is being laid right now, during this slow, frustrating phase when most people are losing interest. The key takeaway here is simple but often misunderstood. Do not confuse silence with inactivity. Do not confuse suppressed price action with a lack of demand. And do not confuse frustration with failure. Markets often do their most important work when nothing appears to be happening. This is the phase where conviction is tested and where most participants either become overly emotional or completely disengage. Neither extreme is helpful. Decoupling does not mean that XRP suddenly ignores the rest of the crypto market forever. It means that at a certain point, XRP begins responding more to its own fundamentals than to general crypto market sentiment. When that shift happens, price behavior changes dramatically. Most digital assets today are still trading as pure risk assets. They rise when liquidity expands and fall when liquidity tightens. XRP is slowly transitioning out of that category. As it becomes more connected to settlement, payments, and institutional infrastructure, it starts behaving less like a speculative token and more like a utility-driven asset. That distinction matters far more than most people realize. When people hear discussions about XRP reaching extremely high valuations, many immediately dismiss the idea because they imagine it happening the same way meme coins move. That's a fundamental misunderstanding. Infrastructure repricing does not happen gradually, and it does not begin with retail euphoria. It happens when the market realizes an asset has been structurally mispriced relative to its role. That realization can occur very quickly. If XRP is used as a bridge asset at scale, price stability becomes necessary. That sounds counterintuitive, but it's critical. A settlement asset cannot swing wildly and still be reliable. As usage increases, liquidity deepens. As liquidity deepens, price becomes more resistant to manipulation. And when manipulation decreases, the market is forced to reprice more honestly. This is where supply discussions often miss the point. Many people focus only on total supply without considering velocity and demand. If XRP is moving value repeatedly across the ledger, demand for liquidity increases. Institutions need access to XRP not to hold it indefinitely, but to use it continuously. That creates a constant baseline demand that fundamentally changes how price behaves over time. Another factor that is often underestimated is systemic risk. As stress builds in traditional markets, institutions actively look for ways to reduce friction and counterparty exposure. Blockchain-based settlement offers near-instant finality, which becomes extremely attractive during periods of volatility. XRP's design aligns closely with that need. It's not about replacing the entire system overnight. It's about improving the most fragile parts when pressure rises. Timing is also critical. Decoupling does not happen when everyone expects it. It happens when positioning is already complete and when the market least anticipates it. Right now, most people are focused on short-term disappointment. That is rarely when major moves begin. Big transitions tend to start when boredom peaks. This is why sentiment indicators matter. Historically, extreme fear and apathy have always preceded significant shifts. When participants are emotionally exhausted, they stop paying attention, and that creates the ideal environment for structural change. Regulatory clarity is another important piece of this puzzle. XRP has already gone through regulatory scrutiny. That process removed a major unknown, even though it was painful at the time. Many other digital assets still carry unresolved regulatory risk. Institutions care deeply about that distinction. They don't want surprises. XRP's relative clarity makes it easier to integrate into compliance frameworks and operational systems. That alone changes how it's evaluated behind closed doors. We're also seeing early signs that traditional finance is beginning to understand XRP differently. When people inside established financial institutions start saying they understand how XRP fits into settlement and liquidity, that's meaningful. Understanding always comes before adoption. Adoption comes before capital flows. Capital flows come before price. This sequence rarely changes, even though it often feels slow while it's happening. It's important to stay realistic. A dramatic repricing does not happen overnight. It would require sustained liquidity, real institutional usage, and a fundamental reassessment of XRP's role. But dismissing the possibility entirely without understanding the mechanics is just as flawed as blindly believing it. The more important question is direction, not exact numbers. If XRP decouples, its price will no longer be driven solely by Bitcoin cycles. It will be driven by how much value flows through the network. That is a very different model, and one most people are not used to thinking about. Markets don't announce transitions. There is no countdown or warning. One day, behavior simply changes, and by the time most people notice, the structure has already shifted. That's why patience and understanding matter more than prediction. Those waiting for perfect confirmation often arrive too late. Those who understand the mechanics early don't need to rush. They just need to avoid being shaken out during the hardest part of the process. As we move forward, the most important thing is staying grounded. Extreme hype and extreme fear are equally dangerous. What matters is understanding fundamentals, positioning, and macro conditions together. XRP sits at the intersection of all three right now, which is why it continues to draw attention even when price action feels disappointing. No asset exists in isolation. The crypto market does not move on charts alone. It moves within a global system shaped by debt, liquidity, interest rates, and political decisions. And right now, that system is under serious strain. One of the clearest signals of that strain comes from government bond markets. Bonds are supposed to represent stability, safety, and confidence. When bond yields spike sharply, it means confidence is breaking. Japan's situation is especially important. Their economy has relied on low rates for decades. When their 10-year yield rises aggressively, it tells us that pressure has reached a level that can no longer be hidden. This matters because stress in one major economy rarely stays contained. It spreads through interconnected financial systems. And when stress spreads, central banks respond the same way they always have. They inject liquidity, they lower rates, they support markets, not because they want to, but because the alternative is systemic failure. That brings us back to leadership expectations and monetary policy. Markets are already looking ahead to potential shifts in central bank leadership and policy direction. Whoever controls future monetary decisions will shape liquidity conditions for years. Markets don't wait for confirmation, they position early. That's how capital behaves. Liquidity is the fuel that drives all risk assets. When liquidity returns, it does not arrive slowly. It floods the system. And when it floods, it looks for the most efficient pathways. This is where blockchain-based systems become critical. They allow value to move faster, cheaper, and with less friction than traditional rails. XRP fits directly into that need. It was designed for speed, efficiency, and scale. It's not trying to replace everything. It's focused on improving one of the most critical functions in finance, settlement. When liquidity surges, settlement systems feel stress first. Systems that can handle volume without breaking gain adoption quickly. That's not theory, that's history. This is also why ETFs matter so much. ETFs act as accelerants. They simplify access, remove friction, and allow large pools of capital to enter without changing behavior. Once ETFs become more common, the line between traditional finance and digital assets starts to blur. We already know that more crypto ETFs are expected beyond the initial wave. Asset managers don't build infrastructure unless they plan to use it. XRP's regulatory position makes it a logical candidate in that environment, even if conversations are happening quietly. Institutions don't broadcast preparation. They execute it silently. They don't chase tops. They prepare for cycles. They think in years, not weeks. They position ahead of policy shifts, not after them. When you see signs of preparation, it usually means the move comes later, not immediately. This is also why market suppression often increases before major transitions. Suppression allows accumulation. Volatility discourages weak hands. Boredom clears out speculators. What remains are participants who understand the structure instead of reacting emotionally. This is not conspiracy thinking, it's market mechanics. What makes this moment unique is how many signals are aligning at the same time. Macro stress, policy shifts, ETF expansion, institutional understanding, and retail exhaustion. These conditions don't appear together often. When they do, they tend to produce outsized moves. XRP has historically moved when conditions align, not when attention is highest. It often surprises both supporters and critics. That's why emotional reactions around it are so common. Some expect too much too soon. Others give up entirely. The more effective approach is balance. Recognize potential without ignoring risk. Understand that timing is uncertain, but direction can still be evaluated. XRP is positioning itself closer to the system, not further away, and that alone changes how it should be assessed. As liquidity cycles turn, assets already integrated into financial workflows tend to benefit first. Assets relying purely on speculation often lag. This isn't favoritism, it's function. Markets reward preparation over reaction. XRP occupies a position very few digital assets have reached, a place where it's being discussed not just as a trade, but as a tool within the financial system. The frustration many people feel right now is understandable. Price has not reflected the amount of progress happening behind the scenes. That disconnect creates doubt. But in markets, doubt often appears just before clarity. Comfort usually signals risk. Uncertainty often signals opportunity. One of the biggest mistakes participants make is assuming price must move before value exists. In reality, value is built first. Price follows later. XRP's value proposition is no longer theoretical. It is operational. It is being tested, integrated, and refined in real environments. That process is slow and often invisible. But once it reaches critical mass, change can happen very quickly. This is why patience matters. Not blind patience, but informed patience. Understanding why an asset exists and what problem it solves matters far more than staring at short-term price action. If conviction is based on function and long-term relevance, volatility becomes easier to manage. If conviction is based only on price targets, every pullback feels like failure. It's also important to separate probability from certainty. There are no guarantees in markets. XRP could face delays, setbacks, or shifts in adoption timelines. But the probability of it remaining relevant within a future financial system is higher today than it has been in the past. That probability shift is what serious market participants pay attention to. They don't need certainty, they need favorable odds. We are also entering a phase where retail influence matters less and institutional behavior matters more. Institutions move slowly, but when they move with size. Their decisions are driven by infrastructure, compliance, efficiency, and risk management. XRP checks more of those boxes than most digital assets. As liquidity conditions eventually change, capital will look for systems that can handle volume without breaking. That's where XRP's design becomes valuable. It's built for throughput, reliability, and settlement finality. Those qualities may seem boring in speculative bull markets, but they become essential during periods of stress. Another critical element is emotional discipline. Markets are designed to test it relentlessly. Noise increases, opinions get louder, predictions become more extreme. None of that changes the underlying mechanics. Staying grounded, informed, and flexible is the real edge. That doesn't mean ignoring criticism. In fact, listening to opposing views strengthens understanding, but criticism should be evaluated against facts, not emotion. Over time, reality has a way of asserting itself, regardless of narratives. What you should take away from this discussion is not a promise of price movement, but a framework for thinking. Ask better questions. Why is price behaving this way? Who benefits from this structure? What happens when conditions change? These questions matter more than any single prediction. At Lion of Crypto, the goal is to raise the level of conversation, to look beyond daily candles and understand systems, incentives, and cycles. That approach doesn't provide instant gratification, but it does provide clarity. If you've made it this far, I genuinely appreciate your time. If this breakdown helped you see the bigger picture, make sure to support the channel by leaving a like, subscribing, and turning on notifications so you don't miss future updates. And don't hesitate to share your perspective in the comments. Thoughtful discussion adds value, even when opinions differ. We're entering an important period for the crypto market and for XRP specifically. Staying patient, curious, and disciplined matters more now than ever. Remember, the biggest moves rarely begin when everyone is watching closely. They often begin when most people have stopped paying attention, when conviction is low, and when doubt is high. That's usually when structural shifts take place quietly. As always, stay focused on fundamentals, stay aware of macro conditions, and avoid being pulled too far in either direction emotionally. Markets reward those who can stay balanced through uncertainty. XRP continues to sit at a unique intersection of utility, regulation, and institutional relevance, and that positioning will matter as the broader system evolves.